All right, let's turn back now to the major indexes. And joining us now to discuss the market day is Kathryn Rooney Vera, Chief Investment Strategist at Baltic. Kathryn, it's good to see you this afternoon. So, markets down. The NASDAQ significantly underperforming today, closing at those session lows down 1.7% after rallying more than 3% yesterday. What do you make of today's market action?
Well, what has taken us to these highs, Kristen, is fiscal and monetary stimuli. The market has repriced the risk of the magnitude of those stimuli and the possible resulting pressures on inflation that could happen. And I think that's really at the crux what can take markets lower and lead us to the next correction. The market last week started to price in the real possibility of inflation, aggravated by a 70% jump in monetary base, a 26% jump in M2, and a quadrupling of the fiscal deficit, all within the context, Kristen, of a recovering economy and a pandemic that's improving in terms of vaccinations and new cases, et cetera. So there's a lot of pent-up demand still to come. And I do think that the market is repricing. We saw this in yields ascent. And the ascent in the 10-year Treasury last week really put into question the equity risk premium that portfolio managers and investors have really counted on for some time. So I think the real question is, how far do U.S. Treasury yields rise? And how much is that a risk to equity markets?
Of course, that is a big question, and I think many people with an improving economy, some sense of normalcy expected at least in the second half of this year, more normal than we're seeing now, and more vaccines, that the 10-year Treasury will rise from here. Kathryn, is that your expectation, and what's the net impact on stocks?
Well, the impact is negative, as we saw last week, and historically has been the case. So as we all know, from year to date, Treasury yields have risen approximately 60 basis points. So the velocity of that ascent, I think, is what the Fed is going to be really laser focused on. If that ascent continues that trajectory, today we had, a sigh of relief from the trend ascent and the steepening of the yield curve. But if we were to resume that velocity of ascent, I do think the Fed would get involved with yield curve control. I've heard guys talk about Operation Twist, but there's also the possibility of increasing their $120 billion in monthly asset purchases and making that larger to really put a cap on yields. So I think the Fed is reluctant to allow financing costs to risk the economic recovery that we've seen, pretty robust so far. But were it to allow inflation to ultimately run its course and maybe run too hot, then I think the market loses confidence in what heretofore, Kristen, has been this kind of blind faith and confidence in the Fed as this omnipotent entity, which is the world's most important investor and the owner of more than a quarter of U.S. Treasuries, to really handle the economy and the crisis from here.
And certainly we've seen those expectations priced into this market since that March 23rd low, when we got the commitment to unprecedented stimulus from the Fed. Kathryn, I know you've been watching that as well, obviously, over this past year. Let's talk about the retail trader Rocket Companies, the owner of Quicken Loans and Rocket Mortgage, surging today, closing up about 80%. It is a highly shorted stock, according to CNBC. So there could be retail trader activity in this, perhaps a Reddit-fueled rally. On top of that, a company that would benefit from lower rates that would drive up the demand for mortgages and refinancings. What does this tell you about the retail trader and how prevalent and how much weight they hold in this market?
That's a great question. I think to close the circle of the thought is that the Fed is really been the motor of growth in markets, small caps as well as value stocks and tech as well. And I think the market is, and the retail investor is reevaluating valuations, not only of tech, which is more than a quarter of the S&P 500, but really reanalyzing the euphoria that has been baked into the markets and how much the Fed can do. And if inflation is going to end, the main driver of market growth for the past year, which I think has unequivocally been Federal Reserve asset purchases, and as I mentioned previously, a quadrupling of the fiscal deficit with more to come. So we had 0.9 trillion in December in fiscal spending. We had 1.9 trillion that's going to be approved this week or next. And more likely than not, another multi-trillion-dollar package to be announced in March, not COVID related. So really what can take, I think, sentiment lower is the fact that what has taken us to these levels could be coming to a screeching halt. And that, Kristen, has caused people to really reevaluate valuations at current levels. And that is, I think, why technology, which has certainly been the massive star of this 100% rise in the S&P since, as you mentioned, March 23rd of last year, to be called into question.
Yes, it's been interesting that we see some investors buying the dip, but the index, again, underperforming today. To your point there, Kathryn, what do you recommend to your clients? Should they be acting on this market pullback and some of the volatility that we've seen of late? And if so, how?
I think in the absence, in the very near term, Kristen, of inflation, I'm talking within, the 6 to 9 month time frame, that investors should remain long risk assets. I particularly like emerging markets at these levels. They've seen a big pullback. Of course, it's kind of a very high beta. So when you see the S&P pull back 1, 2, 3%, EM gets decimated. So I think that if we maintain the current trajectory, which is a fiscal and monetary stimuli in the absence of inflation from here through year end, we're going to get another risk on rally. And in that case, I think we want to be invested in those sectors in the US, for example, staples or, defensives, even banks that have pulled up the rear or dragged the broader market, as well as those areas or pockets of value in the world, such as the emerging markets, which up to now haven't seen that tremendous bounce in value. So that's where I'm recommending clients start to position and hedging themselves with inflation protected instruments such as tips and gold, even Bitcoin. Really, I mean, there's an argument to be made that that's a good alternative in a crisis of confidence in what I call, crisis of confidence in fiat money. But I think put options are attractive. I think defensives are the way to go. And I think investors need to be positioned for that 18 to 24 month scenario where we do get a resurgence in inflation.
All right, Kathryn Rooney Vera, Chief Investment Strategist at Baltic. Kathryn, thanks so much.